Oh, well, hello, and welcome back to Principles of Accounting 2. I'm your host, Dr. B. Everyone's fresh off of their spring break, which is probably why half the class is currently missing. Um, I'm sure they'll join us. I'm certain of it. Maybe they're taking a little extra time for themselves, which is totally cool. That's, no worries. Um, I wanted to quickly touch bases as to where we are in the class, and then we'll jump right into today's lecture on budgeting. So when you're in the classroom, you're coming down, you're fresh off spring break, you're like, oh, Dr. B, I'm so tired. My spring break wasn't long enough. Okay, I know, I hear you. So remember, before spring break, you had your midterm exam, then you had the spring break, and now you're back in class. So it's been some time since I've seen you. It's been, I don't know, 2 weeks at least, right? So here we are, we're back in the classroom. We're about to start our discussion on budgeting. So what does that mean for us? So we made it past the midterm. We made it past spring break. So that means we're in module three. Module three. So you click module three, select week 9. Module 3, week 9, you'll see the PowerPoint presentation of what we're about to go over and with a full discussion on budgeting with plenty of examples because I got a lot of examples from this topic. There is the chapter 22 exercises. Remember, exercises are optional. Exercises are optional. The exercises are optional. They're there for your practice, yeah? The exercises are a couple of Excel documents if you're interested in doing them to get a little bit more hands-on experience, especially with budgeting. And then for this Sunday night, you'll have your Chapter 22 homework assignment. It's very similar to the setup of previous homework assignments, about 5 questions, true, false, multiple choice, all that fun stuff. So that's kind of how the week is going to go this week. So so remember, it's just like the previous weeks. It's been 2 weeks since we've seen each other. We're in Module 3, Week 9, Chapter 22. It's on budgeting. PowerPoint's there. The exercises are there for you to practice. And then, of course, you have the homework assignments for this week. Homework assignment, same as before, about 5 questions roughly, true, false, multiple choice. Remember, there are 2 attempts on every homework and quiz available. 2 attempts on every homework and quiz available. So if you're not satisfied with the first go around, if you're like, oh, I didn't do so well, I'd like to get some more points, or oh, I didn't quite understand that, maybe I should try it again. So, so remember, you got the 2 attempts. Very, very important you take advantage of that. So without further ado, let's get into our discussion on budgeting. And this chapter, to me, or this discussion we're about to have on budgeting, to me, very important. Very important. Budgets give the business and the individuals permission to spend. Permission to spend. That's how I feel about budgeting. It gives us permission to spend. It tells us what we should be spending on. That's what budgets are great for. I have a personal budget for the household. Oh my, I got a budget for food, I got a budget for utilities, I got a budget for, whatever, right? For rent, got a budget for that. Uh, you know, it tells me what I should be spending on. It's my roadmap, right? That's what a budget is. It puts things into perspective and gives us parameters. It says, okay, this is what I should be spending, what's what I should be spending it on. So budgeting is so important in business because we can budget for pretty much everything. I can budget for labor. I can budget for materials. I can budget for overhead. I can budget for other aspects of production, right? That the power of budgeting is so important, and I'll talk about it from a couple different perspectives. One of those perspectives being from the hospitality industry, I'll give you a story about a time where we had to do a comprehensive budget for the hotel, and I had to work with a bunch of different department managers. And you know how it is working with a bunch of managers, right? It's like, okay, everyone has their opinion, and everyone wants to spend money. So, me as the controller, I'm like, okay, everyone, this is the budget amounts. I need you to tell me what you plan to spend that on for your respective department. We would have those types of meetings and this whole exchange. I'll give you examples when we talk about it. So there's a lot of benefits to budgeting. For me, the biggest budget benefit is the control, because it gives us benchmarks for the actual to the estimate, right? Uh, every month I have a budget, and each line item is budgeted on the income statement, on the balance sheet. And I could say, okay, I'm looking at my income statement. I have a line for utilities, and oh, I budgeted $200 for the month. Oh, it came in at 250. So I went over budget for utilities for the month. So I compared the actual utility bill to the budget for utilities. So it gives me control, right? Because now I can say, okay, well, now I know that the month of February to think about for next year, I can adjust it a little upward because I think it'll be higher in that next year, right? So control. Budgeting gives us a plan for the future, right? It says, hey, these are the amounts that you should be spending on each line item. That's why I like budgeting and I budget for the whole business for 12 months, and each line item has a budgeted amount. That helps me to plan. It also motivates me to sell more, right? Because we need to we need to improve our sales in order to get more cash flow coming in so we can improve our budget for the following year. So there's some motivation behind budgeting. It also helps the business to coordinate. Earlier, I talked about, from the hotel perspective, I used to have to work with all of the different department managers at the hotel. I had to work with the chief engineer for the engineering department. I had to work with the front office, the rooms division, the food and beverage division, the restaurant, uh, back of the house. There's so many different departments, right, in a hotel that people don't think too much about. But it's so important that we coordinate with all of those department managers to help to construct the master budget. And what that does is we all sit down, we have the conversation with the department managers. We're coordinating. We're on the same page, as they say. And so that is one of the benefits of budgeting. It puts everyone on the same page. And of course, it also improves things like communication for management throughout the organization. You have all the managers on the same page. And we're all saying, oh, this is in my budget, this isn't in my budget, those types of things. And the everyone is together, and we talk about what our goals are for our departments, and that provides a greater sense of coordination. So really, there's a lot of benefits to budgeting. Finance. Finance is 80% behavioral, 20% book knowledge. Yeah, finance is 80% behavioral, 20% book knowledge. What do I mean by that? We, as humans, We act based on emotion, behavior. We act on our self-interest. We act on our desire to get ahead. And all of these things interact with money, right? It's like think about it. The last time you had a bad day, you're like, I had a bad day. I should treat myself to something nice, right? Oh, I should treat myself to the spa. I had a bad day. So because you had a bad day, you went and blew $500, right? That's behavior. That's a behavioral thing. But we as humans, we act on behavior. So budgeting can have both a positive and a negative effect on human behavior. From a positive perspective, budgeting can motivate employees to attain goals, and uh, everyone feels like they're involved in the process. And we can look at the differences between the actual amount and the budgeted amount. Those are all good things, right? Those are all positive factors for motivating our people through budgeting. But a budget could also have a negative effect on human behavior. For example, and this one drives me nuts, this first one here. Employees may understate sales and overstate expenses to allow for a cushioning. Oh, I hate cushioning. I don't like that. The goal of a budget is not to give a cushion. All right? Like, if I understate my sales, I'm going to sell more. Oh, it makes me look good as a human, right? And it's like, oh yeah, he's a top performer. Really? He gave himself a really low bar. So if you give yourself a low bar for sales and you go over that, it makes you look great. That's cute. But at the same time, it affects the budget negatively. You brought in more sales, so I could have used that additional revenue in the budget toward expenses, right? Or if the manager goes, hey, I'm gonna overestimate these expenses, so later on I can move money around. That drives me insane as a financial controller. It drives me crazy because these managers, they'll pad their budgets to make it look like, oh, I came in under budget. I came in under budget. It's like, yeah, you also said that the electric bill was going to be $500 when it was only $250. It's like budgets don't work that way. People think that, oh, I can just take some budget out of this category and put it in this category and move things around throughout the month. No, you can't do that because when you do things like that, you're altering the plan. You're altering the effect of budgeting. It's like, well, why even have a budget if you're going to be moving funds around in your budget as the month's going on, right? So that first one drives me absolutely crazy. As a financial controller, I see it all the time, and I know businesses do that all the time. They'll say, "Oh, my electric budget, oh, I budgeted $350, it came in at $200. Oh, let me just take that extra $150 and put it in this category." No. So they overstate the expenses to allow for cushioning. The idea of a budget is you want to come in as close as possible to that budgeted amount. Almost every single organization on the planet, including government agencies, have budgets. Okay, maybe not all of them, but most of them do. Okay, so the majority of organizations on the planet have a budget. The idea of having that budget is to come in as close as possible to the budgeted amount. What that does is it provides a set of guidelines a plan for the future, right? Because when I go to create next year's budget, I'm doing it based off of this year, right? What happened this year? My expenses went up. Okay, I should plan for higher expenses next year, right? That's what the budget tells me. That's how I plan for it in the future. And so when my employees go and understate their sales and overstate their expenses, that drives me crazy because that screws with my ability to budget for the next year. So something to think about. Sorry I took a little time on that one, but that one's like, as a manager or a business owner, that one is going to be super important. So when you think about budgeting, the goal is to come in as close to the budget as possible. So when you look at your actual performance and you compare that to the budget, the numbers should be very close to each other. Sometimes there's pressure on people to perform, right, at work. And sometimes that pressure to perform at work can result in unethical behaviors or fraud in some cases. So that's one of the negative consequences of budgeting. And one of the third, this last one is interesting too, because sometimes like we think about a budget and we say, oh, I have enough in the budget to make these purchases. And you're buying stuff you don't need, right? To ensure that the budget isn't reduced for the next period. So in government, for those of you who are familiar with government agencies, in government there's a saying: we need to spend the budgeted amount this year in order to receive the same amount next year. That is unfortunately very true in government. So government agencies are notorious for wasting taxpayer dollars because they're afraid that if they don't spend the budgeted amount that they have for the year, they won't receive the same amount next year. That's a negative human behavior. So, but unfortunately, it certainly happens a lot. So those are the behaviors. Let's talk about reporting. Having a rolling budget is so important. And I briefly talked about this in Accounting 201. I don't know if you remember the conversation. But one thing I had said is, when I'm planning my business, I plan 12 months into the future at all times. What I mean is, I budgeted out from January 2022 all the way to December 2022. That's full 12 months, right? So when January 2022 finished, I have already budgeted for January 2023. When February 2022 finished, I had already budgeted for February 2023. When this month finishes, I will complete the budget for March 2023. I always have 12 months in front of me that has been budgeted. We call that a rolling budget. There's always 12 months budgeted in front of me. We call that a rolling budget. And I always do it, most businesses do it that way, because it's important for me to plan 12 months out, regardless of what's happening, right? Because that provides the business with the plan to spend. Continuous budgeting over 12 months. So important. Here we go, the master budget. The master budget is the budget for the whole company. That's what we call the master budget. It's the budget for the whole company. Every single department is included in the master budget. Okay. Earlier, I talked about the budget from the hotel business. And we have the front of the house, front office, rooms division, uh, food and beverage division, banquet division, uh, back of house, etc. Right? And then, of course, the support departments like HR, uh, accounting, sales, right? Those are the support functions. So I have all of these departments at the hotel, right? And so what I do, usually starting, if I want the budget to be implemented in January, I start like in August or June, July, August. I start the budgeting process for the next year. And so the way it works is I went to each department manager and I said, hey, here's your dollar amount. I need you to tell me what you plan to spend that on for the next year by a detailed line by line budget. And so each department manager will do that. It takes months, right? It literally takes months to plan, especially if you have a huge department. And so I would come back to them a month or two later, say, hey, okay, so let me see your draft. I would get their draft budgets, and I would start to compile them. And I would take all the department budgets and create what we call a master budget for the whole hotel, right? And so that's what master budgeting is. What this chart shows us, the one that we're looking at right now, shows us a master budget from a manufacturing perspective, which is what we've been talking about the past 8 weeks in this course. We can see that all of our budgets within the master budget is derived from sales. Sales drives the master budget. The sales budget's the most important one. Why? Because if I don't know how much I'm going to sell, I don't know how much I need to manufacture. Right? Like if you go, oh, I expect to sell $5 million worth of product this year. Okay, so great. That tells me how many units I need to manufacture based off of the sales amount per unit. Right? And so from the sales, the projected sales, the sales budget, I can then create a budget for production. Also from sales, I can create a budget for capital expenditures, which is investing in property, plant, and equipment. I could also budget for selling expenses, like salaries for salespeople, management, etc. So I can create the budgets from sales. It all starts in sales. I create the sales budget based off of the estimates that they expect to sell in the following year. I plan my capital expenditures and selling administrative expenses, and I also budget for production. You said you're going to sell $5 million of product next year. Therefore, I need to manufacture X number of units to meet that sales goal. And of course, we know what's involved in producing a single unit: direct materials, direct labor, factory overhead. And so I'll create a budget for direct materials, a budget for direct labor, and a budget for factory overhead. And those three budgets together tell me how much I need to budget for cash, how much cash I need to budget going outward throughout the year. And all of that together creates the master budget. So let's talk about each of those things one by one. The first step in preparing a budget, any budget really, is the revenue. We need to budget the revenue, the sales, right? That's the first step. I need to look at how much I have coming in or expect to have coming in. I'll say, hey, I expect that I'm going to sell X amount of dollars this coming year. And that will tell me, okay, so that means you expect to sell X number of units in the coming year. And that's how we start off. We start off with the sales budget. It's the budgeted amount in sales dollars and in units. And that will help me to plan, of course, for the future. So, but how do you do that, right? It's like, how do you know, how do you plan? How do you plan a sales budget? Well, I look at my current units and how much they're selling. So what is the market condition? And I also look at what is my capacity and what are my plans for advertising in order to increase my sales of those units. When I figure out the market condition, meaning people's ability to buy my products, and I figure out what my advertising plan is and what my capacity is, I can then estimate the number of units I'm going to produce and estimate the price per unit. That will help to create the sales budget. Here's an example. I like this example. Here's an example for what appears to be the third quarter. So October, November, December. In the month of September, before this budget, we sold 700 hockey sticks at $60 a piece. It's not bad, okay? 700 at $60 a piece is what I had sold in the month of September. So we prepared a revised budget for the next 3 months, and it looks like this. Month of October, we expect to sell 1,000 units. November, 800 units. December, 1,400 units. And each unit sold at $60 a piece. Month of October, my expected revenue budget amount, expected sales, 60,000. Expected sales for November, 48,000. Expected sales for December, 84,000. For the quarter, for the fourth quarter, I expect to generate $192,000 in sales. Again, budget. And the budget is based off of the historical data. So that's the sales budget. And that's typically with a sales budget, it depends on the type of company, how far you can really project outward, right? Like if it's a brand new company, I don't know how many units I'm going to sell next month or even this month for that matter. So usually let a few months go, and then that helps to guide the plan. So that's how sales budgeting works. Number of units I expect to sell times the sales price. Now that I know how many units I expect to sell based off of the sales budget, I can now budget for production. Now I know the number of units I expect to sell and the amount I expect to collect from those sales based off of the sales budget. Now I can do the manufacturing budget. We start with production. So what we do is we look at our ending inventory how many hockey sticks do I have in inventory already, plus the number of units I expect to sell during the period. That gives me the required units for that period. So what I already started the period with, right? Ending inventory, plus the budgeted sales units, the amount that I expect to sell during that accounting period. Minus the beginning finished goods inventory. That's what I have already manufactured. Okay, those are already completed hockey sticks. That gives me the number of units I need to produce. Make sense? Yeah? Y'all there? Y'all awake? That was a long break.
We still here.
All
Yeah, we
right.
here.
Right on, thank you. Okay. It's also important to understand that the production budget doesn't show me the cost. It shows me basically, it only shows me how many units I need to produce. That's what a production budget shows me. There are other budgets that show cost. So here, going back to our example, okay, going back to our hockey stick factory example. So looking at October, November, and December. We have some data here, all right? The data is the following. Of the amount I expect to receive from the sales, I expect to sell in October 800 units. Okay. I'm going to factor that I'll actually sell 90%. I'll actually sell 90% of that. Remember, the 800 is just a budget. I expect to sell 800 units. Doesn't mean I'm going to. So we'll say, hey, you know what? We'll sell 90% of that. So that will leave us with 720 units. I'll add in the 1,000 units that I budgeted to sell, which will give me the required units available for production. So basically, I can manufacture up to 1,720 units. But I probably already have a few units already made. Remember, the company's ongoing. It's not like the first it just started. No, we sold some stuff back in September, right? So that tells me I ended the month of September with inventory, with finished units, right? So I'll subtract out those finished units of 1,010. And that'll tell me that I need to produce 710 units. You see this little red arrow? This red arrow shows us that the budgeted ending inventory, what that means is I expect to, I'm selling through 90%, so I expect to end the month with 720 units in inventory. So that'll become the beginning inventory for the next month. If I'm ending October with 720 units, that means I'm beginning November with 720 units. The month of November, I expect to sell 1,400 units. I'll end up selling 90% of that, which means I'll end the month of November with 1,260 units. I'm going to add in the expected sales of 800 units, which means I have available to manufacture 2,060 units. I'll subtract out the beginning balance inventory that I got from October, 720 units. And that means for the month of November, I need to produce 1,340 units. And then it continues like that, right? And we do the same thing for December, so forth and so on. What this shows us is the number of units that I need to produce each month based off of the projected sales. Now that I know how many units I need to manufacture for each month, see, 710, I need to manufacture 710 units for October, 1340 for November, and 950 for December. Now that I know how many units I need to manufacture each month for the next 3 months, I can determine the amount of direct materials I'm going to need to purchase in order to manufacture that amount of units that I need to make. So we said that we need to make 710 units in the month of October. The materials requirement per unit is half of that. In other words, I need half the amount. I need half the amount of wood, essentially, right? So that means I need 355 pounds of wood to create these 710 hockey sticks. I'm going to add in what I already have in terms of wood. All right, I already have 335 pounds that was left over from September. Or, I'm sorry, I'm going to add in the amount I expect to end the month with for the month of October, which is going to give me 690 total pounds of wood. Now I'm going to subtract what I started the month of October with, 178. So that means I need to purchase 512 pounds of wood in the month of October. And at that time, each pound of wood is $20 a pound, which means 512 times 20, I'm going to need to budget $10,240 for wood in the month of October. And then I do the same thing for November and December. In November, I expect to make 1,340 units. I need half that amount in wood, which is 670, which also happens to be half the amount of the 335 from the previous month. Plus 237.5 pounds equals 907.5 pounds that I need for the month of November, minus the ending inventory amount, 335, which means I need to purchase 572.5 pounds of wood at $20 a pound. My wood budget for the month of November is $11,450. And I do the same thing for December. But you see how that works, right? The idea here is that I'm creating a budget for the amount of direct materials that I need to purchase in order to manufacture the budgeted amount of units for each respective month. Now, you know, we can't talk about manufacturing without talking about labor. We talked about direct materials, now we've got to talk about direct labor. I need employees to make these hockey sticks. So I need to budget for the labor. So here's how it works. We know how many units we need to manufacture in each month. October 710, November 1340, December 950. I know how many units I need to manufacture in each month. And I also know how long it takes me to manufacture one hockey stick, about 25 minutes. So if it takes 25 minutes of an hour, so 0.25, 25 minutes of an hour, 0.25, times the number of hockey sticks I need to manufacture, 710. That means I will need a budgeted amount of 177.5 labor hours to manufacture all 710 hockey sticks. So in the month of October, if I need 177.5 labor hours to manufacture 710 hockey sticks, and each employee earns an average of $12 per hour, that means I need to budget for a labor cost of $2,130 for the month of October. How did I get that? I took the amount of hours I need for the month of October, 177.5, times the $12 per hour average to get $2,130 for the month of October for labor. And I follow that same process for November and December. It's the number of units we expect to manufacture times the amount of hours, or minutes in this case, to manufacture each unit, 0.25. Number of units times 0.25 equals the number of hours needed to create those units, times the labor rate per hour gives you the total cost of direct labor for that respective month. Make sense? This one's probably the most straightforward for direct labor. Y'all still awake? Those long breaks, I tell you. Okay. All right, cool. So we budgeted our direct materials, we budgeted our direct labor, now we need to budget our factory overhead. Now, as you know, factory overhead are those things that cannot be directly traced to each unit of production. We know that. But, we need to budget for the factory overhead. And we budget for the factory overhead based off of the number of units we expect to produce in each month. And we use, remember this one, our single wide plant rate method. Single plant rate wide method, whatever, of $2.50 per hockey stick of overhead. Right? That's our applied variable overhead. So we take the number of units we expect to manufacture for each month times the $2.50 variable overhead rate. Gives us our total budgeted variable overhead. Then we add in our fixed overhead rate. And that will equal the total budgeted overhead amount for each respective month. Very straightforward. We have our variable rate times the number of units that we expect to manufacture in each month. Gives us the total variable overhead. Then we add in our fixed overhead to equal the total budgeted overhead for each month. And that's how you compute the overhead rate budget.
Professor,
Overhead
could
budget.
you,
Yes, yeah.
could you say the number of units times the variable overhead rate times the budgeted overhead rate?
Almost. So it's the budgeted number of units that we expect to manufacture times the overhead rate, in this case $2.50, equals the total variable overhead budgeted amount. And then we add in the fixed overhead amount to get the total budgeted overhead amount.
Okay, thank you.
You're very welcome. Yeah, that's factory overhead. So we talked about direct materials, direct labor, factory overhead, all those great budgeted amounts. Okay. So we know what our direct materials are per unit. We know what our direct labor is per unit. We know what our variable overhead is per unit. And we can take the fixed overhead and divide by the number of units to find the fixed overhead rate per unit. So if I add up my direct materials per unit, direct labor per unit, and variable overhead per unit, and then I also add in my fixed overhead per unit, I can find the total product cost per unit. And the total product cost per unit is found through those budgets that we talked about, the direct materials, direct labor, factory overhead. So we found the total cost, right? I need to divide that by the number of units, the total number of units for the whole period. In this example, 3,000, to find the cost per unit. And so we can budget the product cost per unit. So if I make 3,000 hockey sticks, for example, in a quarter, and my factory overhead rate is $1.50 per unit, I add in variable overhead plus direct materials and direct labor to get the total cost per unit. In this example, 17 bucks. Now, that $17, which is the total cost per unit budgeted amount, can also be expressed when budgeting for cost of goods sold. I take the amount of units that I expect to sell during that month times the product cost per unit to get the budgeted cost of goods sold. Because that's how you find cost of goods sold. It's the cost per unit times the number of units sold. That gives you cost of goods sold. So I budgeted for manufacturing, direct materials, direct labor, factory overhead. I budgeted the sales. Well, it all started with the sales budget. Then we talked about the production budget. Then we talked about the total cost per unit budget. And then we talked about the cost of goods sold budget. Now, along those lines, we need to talk about the selling administrative expense budget. The selling administrative expenses, as you recall, are comprised of things like commission, sales salaries, and related expenses of sales, like delivery and shipping, things like that. So we can make a sales expense budget based off of that information. For example, if I know that my salespeople will sell based off of the projected sales budget, I can also budget for total commission. So if they make 10% commission on all sales, I can quickly find the budget for commissions. It's the total sales amount times 10%. And if I have managers that are on salary, well, that's easy. Take their total salary, divide that by 12, and I can find their monthly salary and budget that in. So in our example, in the month of October, I expected to sell $60,000 worth of hockey sticks. If there's a 10% sales commission, the sales commission budget's going to be $6,000. I have a sales manager who makes $2,000 per month, giving me, for the month of October, selling expenses budget of $8,000. I add sales commissions plus the salary. I could also find and create a budget for general selling and administrative expenses. Remember, these are like the related expenses to selling. For example, our company has general administrative salaries of $54,000 per year. To find the monthly administrative salaries, just take your $54,000 divided by 12 to find $4,500 per month of administrative salaries. And we can budget that out for each month. Just the salary divided by 12. So I budgeted for selling expenses, general expenses. I can also create the budget based off of sales for the capital expenditures. Remember, capital expenditures are things like investment into property, plant, and equipment. It could also be disposal of property, plant, and equipment as well. So capital expenditures tells me what I could invest in based off of our sales. You know, purchasing things like new equipment or a new building or whatever, right? So in our example, we didn't dispose of anything, but we did plan to acquire a new piece of machinery for $25,000. And we can budget for that based off of our projected sales. And lastly, based off of all of those budgets, especially the production budget, I can budget for cash. I can budget the amount of cash I expect to have coming in and out of the business for each month. And this is the formula. We take the beginning cash balance plus cash receipts that we expect to collect minus expected cash payments equals the initial cash balance. And then, of course, we can decide if that's going to be enough cash or not, right? If it's good, we can start to repay other debts. If it's not enough cash, we may have to hold off on paying some of those long-term debts. Now, this is the general formula for cash budgeting. So you might be asking, well, how do I know how much cash I'm going to be getting in? And we can estimate that based off of our sales. If we have 40% of our customers purchasing hockey sticks using cash, that means the rest of them are purchasing on credit or on account, which I would expect to collect the following month. As you know, on average, it's like 30 days. It's like you get an invoice 30 days. Okay, you pay the invoice 30 days later. So that gives you an idea of when you would expect to collect that cash. So here are my sales. I expect in the month of September, which already happened, I sold $42,000 worth of hockey sticks. 40% of that I collected on sales. I'm sorry, 40% of that I collected in cash, which means 60% of the 42,000 I would expect to receive in the following month from my accounts receivable. Remember, accounts receivable, that's when you sell something on account. You don't collect it right away. It's usually 30 days later. So for the month of October, I expect to sell $60,000 worth of hockey sticks. 40% of that I expect to collect in cash, so $24,000. The rest of it I expect to collect an accounts receivable in the following month, so $36,000. My cash balance for October would be the $24,000, which is straight cash sales, plus the account receivable from the previous month. So $24,000 plus the $25,200 would mean I would collect a total of $49,200 in the month of October, cash. I'll do the same thing for November and December. November sales, $48,000. I'll collect $19,200 in cash. The rest of it is in receivables from the next month. I'm also going to collect the receivables from the previous month, the $36,000 from October. So cash sales November, $19,200. Cash sales from the previous month's receivables, $36,000. Total cash receipts for November, $55,200. And then so forth and so on. You keep going till infinity. That's how you budget for cash receipts. What about payments? We expect to pay cash for purchasing materials. So how do we know how much cash we need to purchase for materials? Well, it's based off of the production budget. The production budget tells me how many units I expect to produce. It also tells me how many pieces of material I need to purchase. So our company can either purchase that using cash upfront or on account. When you purchase something on account, that means you're going to pay for it later. Accounts payable, right? So what that does is provides me the ability to budget for the cash payments in the following months. And here's an example of that. If my company purchases the lumber for the hockey sticks 100% on account, meaning I pay them 30 days later all the time, then I can budget appropriately for the cash, right? So October, I purchased some materials, $10,240. The previous month, I paid for that in October. I paid for September and October, which means my total cash payments was $7,060. Next month in November, I'll pay October's bill, $10,240. In December, I'll pay November's bill, $11,450, so forth and so on. I mean, I kind of wish it worked that way all the time, but because it's easy, right? So the best way to budget for cash payments and cash coming in. is to use the formula. We take the beginning cash balance plus the budgeted cash receipts, the amount we expect to collect, minus the budgeted cash payments, the amount we expect to pay, equals the preliminary cash balance. If it's a good amount of cash balance we expect, we can start to think about repaying loans or buying investments. If it's not going to be enough, we need to increase our short-term loans in order to get enough cash coming into the business. These are the kind of decisions that we might make. And if I have enough, I can pay a dividend, right? That'd be even nice. So this is an example of our company's, our hockey stick company's cash budget. We'll have income taxes payable of $20,000. We'll purchase some new equipment of $25,000, so there's cash going out. We might take out a loan for $20,000. So forth and so on. So all of these things obviously will have an impact on the cash budget. And here's a nice visual representation of that cash budget for each month. Beginning cash balance plus receipts minus payments, and then any additional financing activities. Beginning balance plus receipts from customers minus payments. Remember, it's cash. We're talking about like the statement of cash flows, basically. It's how you would budget for it. Beginning balance plus cash payments from customers minus payments for the expenses. Interest, etc. Ending balance cash, especially if there's any loans involved. The loans always come last. Think of it like also how the balance sheet's laid out. Your ending balance, cash balance from October, of course, that's going to be your beginning balance for the next month, November. And of course, if there's anything left over, we can pay off some loans. So with all of that information, when we talked about the master budget, right, and we went through all of the different budgeting steps and processes, and we budgeted for our cash, that will allow us to budget for the income statement. Remember, the income statement, we have the budgeted sales already, so the revenue's done. But with the cash budget, it will also allow us to budget for all of the individual expenses. So here's an example of our income statement. Sales minus cost of goods sold equals gross profit. These are all the budgeted sales, budgeted gross profit. I'm sorry, budgeted sales, budgeted cost of goods sold. That will give us our estimated gross profit minus all of our budgeted expenses for sales and administrative expenses. Will give us our income before income taxes, and then we can estimate what our income tax expense will be, and that will give us our budgeted income, net income amount. So it's kind of, budgeting really does help to provide the company with a roadmap. It gives us permission to spend. It gives us a framework, right? That's why it's so important. And after we've budgeted our income statement, we can also budget for the balance sheet. The balance sheet, as you know, has assets, liabilities, and equity, and we can actually budget for each of those items based off of what happened on our income statement and our statement of cash flows. a nice example of it. So everything we just talked about was for a manufacturing company. Uh, Manufacturing is what we focus on a lot in this class because we talk a lot about cost. We could also budget for service companies. A service company being something like a lawn care business, a dentist office, a law firm, um, you know, companies that provide services, a hair salon, a barber shop, etc. They provide services. We can budget for those services as well. And it works pretty much the same way. It's very similar, except obviously the primary difference here is that there's no direct materials and there's no factory overhead because we're not manufacturing. But it all still starts with the sales budget. The sales budget drives the budget for direct labor, which drives the budget for cash. The sales budget also drives the budget for capital expenditures and selling administrative expenses. But we see how the budgeting process always starts with sales. The sales budget's really the most important one because it's the first one. And the rest of the budgets are derived from the sales budget. Budgeting helps us to plan for the future. And the budgeting can also be driven based off of activities. We call this activity-based budgeting. Activities are the actions taken by various departments, right? Those are the activities. And so some companies, they will budget based on activities instead of the traditional line items. And last but not least, a merchandise company. So we talked about the manufacturing company, which is most important. We got to talk about service, and now let's talk about merchandise. As you know, a merchandise company is a company that sells products to generate revenue. An example would be Macy's, or a grocery store, or whatever, Amazon. They're all companies that sell products. They purchase that inventory from a manufacturer or from a distributor. But we see that, guess what? It all starts with a sales budget, even in a merchandising company. The sales budget will help to create a purchases budget. The sales budget will also help to create the capital expenditures budget and the selling administrative expense budget, and all of those together help to create the cash budget. So it's very similar. It's very similar in nature. And here's an example of a company that sells hockey sticks. They buy them from the manufacturer. And they sell those hockey sticks for about $60 a piece. And so this tells us how many units this retailer needs to buy from the manufacturer to sell. So we start with the beginning, the ending merchandise that we have on hand, plus the expected sales for the period, minus the beginning merchandise inventory. That tells me how many units I need to purchase. That's how we would create the purchases budget. So in this example, we ended the month with 1,010 hockey sticks on hand, and we expect to sell a few more. So I can budget for the purchases for each month. It's very similar very, very similar to the way we did it for the service company and for even so the manufacturing company. But we can see how that works, right? We have the budgeted sales, 90% for future sales, gives us the budgeted ending inventory amount, which is used in the next month as beginning inventory, plus the budgeted sales, the number of units I expect to sell during the month, equals the required units available for merchandise, minus the beginning inventory, equals the number of units I need to purchase for the month. And then, of course, I can budget the amount. If it costs me $60 per hockey stick to buy, I take the total number of units I need to purchase times the purchase price, $60, equals the cost of merchandise purchases for each month. For this example, $42,600 for October. And I do the same process for November and December. Yeah, from the sales budget, ending inventory, and then we add in the amount that we expect to sell. From this, we can also see the number of units available. We take out the beginning inventory, and then, of course, we multiply the units that we need to purchase times the purchase price. Give us the total amount for each month. That, friends, is the end of our discussion on budgeting. Are there any comments, questions, or concerns about budgeting? Anything at all? Comments about budgeting?
I think that's an important chapter. That's like the meat and potatoes of business, at least
It
me.
is. Yeah, that's why I like it the most as well, Aisha, because it really does provide the business kind of like with a roadmap, right? That's my favorite thing about budgeting. That's why it's so important. Yeah, you're right. It really is like the meat and potatoes, as you said. Very important aspect. Any other comments, questions, or concerns?
No, very well explained, and which is going to help me with my business.
Great. Hey, folks. That's what it's all about. Is once you have that budget established, it basically tells you what you need to do. That's why I love the aspect of budgeting, because it really does help to provide a plan. Yeah.
Yeah, it does.
Sure does. Wonderful. Okay. Well, if you think of anything, remember, you could email me, call me, set up office hours, whatever it takes. I'm here for you 100% of the time. As a reminder of what's due this Sunday night, you have your Chapter 22 homework assignment due this Sunday night. It's 5 questions, true, false, multiple choice. You could take it twice to earn the highest score. It's due Sunday night. Please make sure it's on time. Timeliness is so important, especially as we get closer to the end of the semester. It's so important that we're on time, right? Because we don't want to stress ourselves out, especially when we get closer to the final exam. And with that, if you have any questions, comments, concerns, email me, call me, set up office hours, whatever you need. I'm always here for you. Office hours link is right there. If you need tutoring, Dr. Remy's there for you. Whatever you need, I'm here. Okay? And with that, please remember to stay safe. Wash your hands. Do the right things, and I'll see you all again, same time, same channel, next week. Thank you all so much for your time today. Enjoy the rest of your week. Thank you so much. Bye-bye.